Okay, so we are now into week 4, and this is where the math portion of FP&A really comes in, because now we start to understand, or now we're kind of starting to get to understand the different ratios and measures that we're going to need in order to come up with actionable conclusions. Now, at the end of the day, numbers are just numbers, right? They don't have context unless you give it to them. So you can't really contextualize what these numbers mean until and unless you compare it to competitors or other firms within the industry as a whole, past performance, stuff like that. So we're going to kind of get into those numbers, and I'm going to split it up by each category as well as what each category depicts in terms of the financial health of a firm and what we as FP&A analysts can deduce from that information. So first and foremost, really briefly, let's just go through the financial statements again. I know I did this the last 2 weeks, but it's super important that you guys understand the financial statements. Obviously you have all 3 of them that are making an impact because they work hand in hand with each other. So the first one, income statement, and this is kind of an end of the year review, view of all the activity that happened in the previous year, how much you earned in revenues, your cost of goods sold, only the ones that you sold. Then you do revenues minus COGS, you get gross profit, minus SG&A, which is sales, selling, general, and administrative, which is like insurance, rent, payroll, stuff like that. Mainly fixed costs, and interest, taxes, depreciation, and amortization. Those last 2 are included within SG&A. So when you subtract SG&A, you get operating income, or EBIT, earnings before interest and taxes. Then you deduct interest expense from debt and taxes, and you get earnings or net income. That's all part of the financial statement. The balance sheet is a snapshot. So this is how much you have in your assets, liabilities, and equity at any given point in time. Whereas the income statement is kind of a summation of everything you did in any given year, a balance sheet is what it looks like and what your firm has at any given point in time. It's a snapshot. It's a picture, basically. It's not an accumulation. And it's a snapshot of, like I said, assets, liabilities, and equity. Liabilities and equity added together are always going to equal your assets. Assets are on the left-hand side. Liabilities and equity are on the right-hand side. You use your equity and liabilities to fund your assets, and they have to match 1-to-1. That's why A equals L plus SE. You can't have assets that are backed by nothing, They have to be backed by either equity or debt. And the right side here gives you an indication of what those assets are backed by. And it generally gives you an idea of a firm's financial health and reserves, as well as future debt. And finally, the statement of cash flows. It provides an overview of a company's liquidity, or its access to cash. How much cash does it have access to? If there were problems with the firm, would it be insolvent? That is generally what a cash flow statement does. How well it's paying off its operating expenses and making future payments, where its cash is coming from. It's split up into operating, investing, and financing. Operating is like net income, amortization, depreciation, stuff like that. Accounts receivable, accounts payable, basically all those short-term assets and liabilities, as well as your income statement numbers, are going into operating. Investing is if you buy or sell an asset, like a plant. Usually it's a long-term asset, like a plant or equipment, or the rights to land, or even land itself. That's investing. And then financing is usually the issuance of debt or equity, or the repayment of debt or equity. Repayment basically means you deduct financing cash flows because you're paying it back. It means you have less cash, whereas issuing debt or equity means you're getting cash now, but you'll pay it off with interest later, which is a good thing for cash flow because we're getting cash in the immediate future. So that's how the cash flow is split up, and that'll give us an idea of what a firm's cash flows are like once we discount them, otherwise known as discounted cash flows, or DCFs, and we're going to get into that a little bit later. All right, this is an example of an income statement. Sorry, Can't talk today. So at the top, we have total revenues and what makes up those revenues. Gross profit, once you deduct, so there's no cost of goods sold here and there's no SG&A here. They do have other income and expense, which they deduct from the operating income. So normally between total revenue and gross profit, you would have a line item saying, cost of goods sold, which is the inventory that you sold. If you're selling shoes, it would be the amount of shoes you sold in a year. And they would deduct that from revenue, and this number for gross profit would be a little lower. Operating income is the same, but normally for operating income, there may be depreciation or rent or insurance. I know they include that here, but generally it should be up here. And then once you subtract that from operating income, you get net income. And then you would also deduct taxes. And I don't think they did that here, but assuming it's a 35% tax rate, you would take 65% of this number, and that would be your net income, essentially. And that's the income statement. It's a bit reductive in this example because they don't include a lot of stuff, but generally this is what it looks like. Revenue, cost of goods sold will be between revenue and gross profit, operating income, and finally net income. And if they pay anything out in dividends, then that's also going to be reflected all the way at the bottom, depending on how much they're paying out in dividends. Balance sheet, this essentially shows assets and liabilities. So I say left and right-hand side. Over here, they just have it in one line. Essentially, let me try to annotate this. So this portion for total assets would be the left-hand side of the balance sheet. And this area, the liabilities plus equity, would be the right-hand side. And so the top is just the total assets, which is the stuff that you have. And the bottom is how you pay for that stuff. So assets, you typically have you have cash, you have inventory, you have debtors, which is accounts receivable pretty much. Those are all your current assets. And by current, we mean that they're assets that are available to you within less than a year. That's what current means. And anything beyond usually a year or 3 years is long-term. The non-current, these are your PP&E, plant, property, and equipment, factories, buildings, all that kind of stuff. These are long-run stuff that accumulate depreciation because you use them for a long period of time. So they're included in non-current. You add them up, you get current. This has to equal liabilities plus equity, which makes sense because if you do 850 plus 425K, you get 1,275K. So we know that this balance sheet is proper, it's correct. It's 1-to-1. Every asset, every dollar of every asset is backed by either a liability or equity. We go down to liabilities, you have current liabilities like credit debt, payments to creditors, taxes payable. Usually you shouldn't have taxes payable. Those shouldn't be on a balance sheet unless, of course, you have approval by the government that you're paying to. Those are your current liabilities. And then non-current, that's long-term debt. That's usually debt beyond 3 years. And that's debt that your debtors know that you're not going to pay off in the immediate short run. And then owner's equity. This is capital, retained earnings, and current earnings. Usually retained earnings is the earnings that you have historically, however long you've been in business. And current earnings is usually retained earnings from the income statement. So we're going to be going over this more in depth next week, but current earnings is essentially your net income minus any dividends that you paid out. And that just gets added back onto the balance sheet in the form of current earnings here. It gets added onto equity, which in turn increases assets. Now, you could use that equity to, convert it to cash. You can convert it to inventory. You can convert it to, funding equipment, buying, new leases on buildings and stuff like that. So that's how to tie together the income statement and balance sheet through current earnings. Like I said, they add up to be total assets. And finally, a statement of cash flows tends to be the messiest and it tends to be the longest, but I think it's the most useful. And why I say that is that it can predict a firm's cash flows very accurately. And how it does this, like I said earlier, is it splits it up into operating, This might be a bit of a doozy to go through, so I'm just going to, okay. This is operating, whereas financing is down here, and then investing is over here. So these are the three categories, and it's split up by all three to show essentially three different functions of how a firm garners cash flows and how they can lose cash flows. You know, collecting taxes. I think this is a municipality, so this is a government agency. This isn't your typical business, but you know, their form of income is tax collection and internal revenue collection. So that's why that's positive. That's cash they got right now. Other receipts or receivables, actually receivables would be negative. So these are just receipts that they have right now. They added that up. They have 14 million in cash inflows. Outflows, these would usually be shown in parentheses like this, but I'm pretty sure they split it up by inflows and outflows, so that's already predetermined. We already know that it's negative. But whatever it owes, that it paid off already. So it already paid it off. We know that the firm doesn't have that anymore, so you deduct that and you're left with this number over here, a little above 6 million. Investing, so it didn't purchase, or it didn't sell anything or purchase anything. So investing cash flows are zero. And then financing, it also didn't pay off any loans, or it didn't issue any debt or equity. And as a result, the money that it garnered in this year, the municipality of, I think, a state in Philippines, is just what they got from their operating expenses. It's the same exact thing, because we didn't have any investing or financing activities. Right? And then you just add that 6 million-ish back to their cash balance from before, which is their previous retained earnings, which we looked at the previous slide, and you get your new cash balance for March 31st, 2011, which is the current period that we're in. All right, so that's how a statement of cash flows looks. And these numbers are super important, because knowing that a firm, let's say in this case, it's not the government, it's a firm, brought in 6 million this year and its present value, that can give us a long-term trend as to what the firm is projected to bring in next year, the year after that. If we brought in 6 million, we can reasonably assume that if it's on track to grow about 10%, then it might be able to bring in, you know, close to 7 million, about 6,600,000. That's why these cash flows are so important. And they really tie in all your financial statements, because you need to borrow from the balance sheet in order to make the operating activities and financing and even investing activities. You need to borrow from the income statement to get your net income that you put into operating activities. And all of that combines to give you your cash flow, either a net positive or net negative. And you use that as a predictor for future cash flow. So that's some financial statement reviews. Didn't take too long, hopefully. It was 20 minutes, 15. All right, now we'll go into the ratios and measures. So there are many types of ratios to gauge a company's financial health. There are technically 4, but I chose to focus mainly on 3, because these are the 3 that get overlooked in favor of profitability a little bit. So I'm just going to go through them. So first off, liquidity ratios. So how liquid is a company? How insolvent are they? Are they able to pay off short-term debt? And some, but not all of the ratios that are liquidity ratios include the current ratio, and we'll go through what these ratios are, you know, what divided by what. Current ratio, quick ratio, which are very similar. It's just the difference is inventory, which we'll get into. Cash ratio, net working capital. Another one is times interest earned. I don't know if I have it in here, but that is essentially, that is how able a company is to pay off its interest expense using its operating income. That's not in here, but that's super duper important. Turnover ratios, they are used to measure the efficiency and effectiveness of management, as well as how efficiently a firm is turning over its cash. So this is asset turnover. So based on your, assets, how much are you getting in revenues? For every dollar you invest in assets, how much are you returning in terms of your revenues? Same thing with inventory. For every dollar you spend in inventory, how much are you earning in revenues? Same thing with receivables as well. If you see turnover, it's usually receivables divided by, these things. assets, inventory, receivables, it could be debt, it could be equity, stuff like that. Financial and business risk ratios. So these are usually stress tests for the financial health of a firm. This is kind of a gray area because it doesn't fall explicitly into one or the other category. What it does is it is mainly a short-term measure that measures the business risk of a company. So you have the three types of leverage, operating, financial, total. We'll get into those later. And they basically measure how dependent a firm, like a firm's cash flows and net income and revenues are on its fixed and variable costs. Its debt to equity ratio. This one's pretty self-explanatory. How much debt does a firm have relative to its equity? What's the capital structure of a firm? Is it using too much or too little debt? And interest coverage, I went over this a little in terms of liquidity. It falls into liquidity as well. This is the same as times interest earned. This is just operating income over interest expenses. So can it pay its short-term interests back? And if not, what the heck can you do about that? And then I included profitability at the end. These are very basic numbers. You know, you see these in the stock market very often. And you see a lot of people talking about return ratios because that's the first thing people think of when they think of investing. While these are important, when you're in the world of corporate finance, you need to be concerned with managing your balance sheet and managing liquidity, as well as risk, in addition to maximizing profits. Like, obviously, the margin is one of the most important things in business, but you also have to manage the balance sheet. So return on investment, return on equity, return on assets, return on debt. This is just net income divided by these things. So you're just seeing for every dollar I spent on equity or assets or debt, how much am I getting back in net income? That's what profitability is. So like I said, we're going to go through some of these liquidity ratios. Net working capital is just current assets minus current liabilities. Do I have too much current debt that's not able to support my current assets? If this number is positive, net working capital, that means that your firm generally is in good shape because you have more assets than liabilities. If your firm were to, face tough times, there are assets that you could potentially sell off or that you could convert. You could capitalize its expenses. You have that solvency option. But if you have too much debt, too many current liabilities, then you have to pay a lot of interest. Those debtors are going to call you real quick and ask for their money back if they sense that your working capital is negative. There's something wrong going on there. Current ratio, this is just current assets divided by current liabilities, whereas a net working capital is minus, this is divided. Usually you'd want this ratio to be above 1, which signals that you have more assets than liabilities. Now, it's not the worst thing in the world if you have less than 1. Usually a lot of banks will have less than 1 because they have a lot of debt. That's pretty much the only way some industries can be run, such as banks. But generally, for projects, a current ratio of above 1 is preferred. Quick ratio is the same as the current ratio, except you get rid of inventories. So the quick ratio is even more aggressive. If that's above a 1, then you're in really good shape. Basically, the quick ratio measures how good the quality of assets are in terms of your liabilities. Because you can have a lot in inventory, but if you're not selling, then that stuff's just sitting. There could be rotting. There could be damage done to it. There could be storage costs incurred by it. So inventory is not always a good asset. So we're just getting rid of it for quick ratio, and we're measuring, accounts receivable and cash, and how many of that we have compared to our liabilities. We want our quick ratio to be above 1. Current ratio being above 1 can be misleading because of, inventory. If we have a high inventory, that's not always a good thing. So that's what the quick ratio is. It's a little more aggressive because it takes out inventory. And finally, we have the cash ratio, which is cash and cash equivalents, which is the most liquid form of an asset that you can hold, and short-term investments divided by current liabilities. So these are just short-term investments and liquid cash. So your most liquid assets, anything that's either cash or light cash, divided by your current liabilities. So the more downward we go, the more aggressive the ratio gets. So you would expect the cash ratio to be a little lower than the quick ratio, and you would expect the quick ratio to be a little bit lower than the current ratio because you're subtracting stuff gradually from the numerator. But the higher the cash and quick ratio are, the better the firm is in terms of its liquidity. But of course, you always have to compare it with other firms in the industry, because you can't always match apples and oranges. You can't compare the banking industry to the tech industry. Two very different industries that have different working capital ratios and liquidity ratios. That's liquidity. Turnover and efficiency. Yeah, so these you can know as the efficiency ratios. And essentially, I did say sales or revenues over stuff, but sometimes it might not be. It all depends on what is driven by what. So for inventory, think about it this way. If you have more inventory, you'll have a higher cost of goods sold, right? Because the more inventory you have, the higher the cost of all of the material that you purchased is. If I have like 100 sneakers, that's not going to cost as much as me storing 1,000 sneakers. So my cost of goods sold, first of all, if I have 1,000 sneakers, I'm probably going to sell more than if I just had 100. So my cost of goods sold is going to be higher. And as a result, we want to measure apples with apples. We don't want to measure apples with oranges. That's why we have COGS over inventory for inventory turnover and not revenues over inventory, right? Because inventory levels, they drive cost of goods sold. That's why the higher the inventory generally, the higher the inventory turnover, the better. It means you're going through your inventory quicker. It's not just sitting there. Asset turnover, this is sales over total assets. This is for every $1 increase in assets, how much is sales increasing, essentially. And you'd want that number to be above 1, but of course, numbers don't matter. You have to always measure it against something else. So actually, even forget I said greater than 1. You have to compare. If the industry average is a 5 times asset turnover, then a 1 is really bad. But if the industry average is a 0.1, then a 1 is really good. So yeah, that's asset turnover. Receivables is credit sales. Now, how this differs from sales and asset turnover is that credit sales includes receivables. So if I purchase something that's like worth $100, but I pay with my credit card now, that's not sales, that's credit sales. I haven't paid yet, but I will pay once I pay my credit card company and that sales is counted, or that sales materializes. So you divide that by accounts receivable, because once again, accounts receivable is driven by sales. The more sales you have, the more likely you are to have more accounts receivable. If I sell $100 worth of goods, I might get a little bit of accounts receivable. If I sell $1 million worth of goods, there are going to be more people that don't pay on time as if I sold 100. So there's going to be more accounts receivable. That's why you do sales over AR for receivables turnover. Working capital is sales over working capital, once again, because working capital is driven by sales. The more assets you tend to have, the higher the sales you tend to have, because you have more resources to devote to sales. And finally, accounts payable turnover. These are purchases, which is a subset of cost of goods sold. It's a pretty big subset, but it's a subset divided by accounts payable. Once again, it's because accounts payable is driven by purchases. The more purchases you have, the higher you can expect your accounts payable to be, because you're not always going to pay your suppliers off quickly. The more you purchase from your suppliers, the more money you'll have tied up in accounts payable, and you'll say, can I pay a few weeks or a few months from it? That just makes sense, right? These are your turnover ratios. This one's going to get a little complicated, but not. Hopefully, I can kind of breeze through it. So these are the risk and leverage ratios. These are more measures than they are ratios in the traditional sense, because these are a little bit more advanced. So let's go into operating leverage. In simplest terms, it measures operating risk or fixed cost risk. So operating leverage tends to be pretty high when a firm has a lot of fixed costs. Think of a cell phone company. A cell phone company, they purchase a lot of hardware. They have to have an environment where they have a lot of software as well. All that inventory is fixed costs, all of that kind of stuff. And then variable costs, they don't have nearly as much of. That's why you see, in the equation, it's sales minus variable costs over sales minus variable costs minus fixed costs. So the only difference here is fixed costs. The higher the fixed costs, the higher the degree of operating leverage here. And it measures the percent change in NOI is just operating income, which is EBIT, that's earnings before interest and taxes, divided by percent change in sales. So for every 1% change in sales, how much is your net operating income changing? If it's above 1, then that means a sharp increase in sales is going to lead to an even sharper increase in operating income. And like a little bit of a decrease in sales can lead to a huge decrease in operating income. This is what firms that have a high operating leverage tend to have. Cell phone companies have high operating leverage. They have low variable, high fixed costs. If they're, when they're selling a phone, they can afford to give a lot of discounts to new customers because the variable costs associated with getting that additional customer is not that high for them. It's not that high for them because most of their money is tied up in fixed costs. That's why they have a high operating leverage. That's why they give a lot of discounts. Like, oh, I'd much rather have you on board at a discount than not have you on board at all. It's not going to cost us much to even get you on board. Here, take this discount. Whereas, a company with a low operating leverage is a restaurant. And this is because a restaurant is almost completely driven by its customers. For every additional customer a restaurant will get, it has to spend more on food. It has to spend more on hospitality. It has to spend more on, tables and chairs. And so every additional customer, and mainly food, actually. Food is the biggest variable cost here. So you won't find deals or anything like that in companies with low operating leverage. They need consistent revenues. They can't have revenues go up or down. They can't afford to give huge discounts. That's why, when you go to a restaurant, you won't see like price decreases or discounts a lot. Maybe some companies, some restaurants have scaled enough to do that, like Chili's maybe, but most restaurants don't do that, especially small restaurants, because they need those sales. And the only good thing about companies with low operating leverage is that if they have a huge increase or decrease in sales, it doesn't really impact their operating income. Their operating income stays relatively steady relative to sales because their operating leverage is very low. For every 1% change in sales, their operating income doesn't really change that much. The good thing is stability. The bad thing is, if sales do go up, you're kind of stuck at that same operating income level. So you don't have a lot of leeway to greatly increase your income. So that's operating leverage. Financial leverage is financial risk. This is percent change in net income divided by percent change in EBIT. So this is how much, this measures how much debt you have. The more debt you have, the higher the interest expense. And firms that have a lot of debt have a lot of financial leverage. Because let's just look at this mathematically. EBIT minus I, right? If I have a lot of I, as I goes up, then DFL also goes up because you're decreasing the denominator, right? So when you decrease the denominator by increasing I, you're increasing leverage, which makes sense. Because think about it this way. If you have like 80% debt in your company and only 20% equity, and if you really lose out in sales, let's say there's a recession, let's say COVID hits, all of a sudden you have to pay off a ton of interest and you don't have sales and you're debt. That's what high leverage does. Now, high leverage can also be really good if your revenues grow a lot and if your operating income, EBIT in this case, if it grows a lot, and if you have high financial risk, if you have a lot of debt, then your net income is going to explode. It's going to go through the roof. It's great in good times, and it's absolutely awful, potentially killer in bad times. And that's completely driven by debt and hence interest expense. So that I right there is interest expense. I'm not going to write it out. It's going to take a while, but very important. So operating leverage is fixed costs. That's what it's driven by. And financial leverage is driven by financial costs. And now we go to total leverage, which combines both fixed costs and interest expense. And this is just percent change in income over percent change in sales. So for every 1% change in sales, how will income either increase or decrease? This is more of a high level look as to how much total leverage you have. The easiest way to do it is calculate DOL and DFL and just multiply them. Honestly, you don't even have to do any of this stuff, like any of the S minus VC over S minus VC minus F minus I. That's all conceptual. Just multiply your DOL and DFL and you get the total leverage. Fairly self-explanatory there. All right, some of the ratios at the bottom, we have debt equity. That's just total debt to shareholders' equity. And by total debt, we mean short-term debt as well as long-term debt. Short-term as well as long-term. So you can't forget either one. Over total equity. Debt to assets, that's just total short-term plus long-term debt over total assets, as we looked at in the balance sheet. Debt to capital is total debt over equity plus debt. And this is the same as percent debt. So this is how much of your financing is driven by debt. Now, if I just replace equity at the top, if I just, replace debt at the top with equity, that would be the equity capital ratio. That would be percent equity. So how much of your assets are funded by equity? This is how much of your assets are funded by debt. That's why you have debt at the top. So that's all it is. And we're going to need that in future weeks when we're studying WACC and all those other financial measures. And at the bottom, debt to EBITDA. And this just measures, how much debt you have compared to how much the firm is bringing in every given year. All right, All right, we're going to do some value forecasting. I think there's 2 more slides, then a very quick Excel demo, and then we're out of here. All right, value forecasting. I mentioned this before, discounted cash flows. So this is why we need the cash flow statement. We essentially see what the cash flows were, even though cash flow statements are as, seen, they're historical facing. Whereas discounted cash flows are usually, they look forward into the future. Now, we use historical values to predict into the future. So if we see we've been growing at 10% the past 3 years, we can reasonably assume that we'll continue growing at 10% or something close to that over the next 3 years. This is where DCFs come in. So it's future cash flows in inflows for a company discounted by the interest rate. This is because of the time value of money. Now, I don't know if anyone here has heard of the pretty old adage that a dollar today is worth more than $1 tomorrow. This is because a dollar depreciates in value over time. I'm not talking about currency. Currency fluctuates all the time. But because of inflation, you'll always have money depreciating in value, declining in value. This is called the time value of money. If you get $500 now, if you have someone saying, I would rather give you $500, a month from now as opposed to $500 now, always take the $500 now, because I will guarantee you that, the dollar will have depreciated a little bit, not in terms of currency, but in terms of inflation, in terms of value. And it's been doing that for ever since we've had currency, pretty much. A dollar worth in 1900 is way more than a dollar worth today. It'd probably be worth like $100, $150 today, or something along those lines. But yeah, so the greater the time horizon of returns, the greater the discount percentage. So the more into the future you look, the greater the discount percentage. And we see that in this equation. So PV, which is present value, equals future value. That's nominal. We haven't discounted it yet. And we divide that by 1 plus R to the power N. R is your discount rate. That's like inflation or weighted average cost of capital, which we'll talk about more extensively the next 2 weeks. And then N, this is the important one. That's how many years or how many periods have gone by. As N increases, that exponent, your PV is going to plummet. If that N is 1, then it's just probably going to be 1.08 or something if your R is 8%. But if that N is 10, then that 1 plus R is going to be bigger. It's going to be a lot bigger, actually. And so FV divided by anything that has a higher N is going to lead to a lower PV. So I'm just going to write that out here real quick because this is a very important thing. So as N increases, PV decreases, and it usually decreases much faster than N is increasing. Okay, so that's very important. As N increases, PV decreases. Very important. Next, we move on to NPV. This is net present value. So this is your DCFs that we previously learned, all of your inflows minus the initial investment or the upstart cost. So how much your firm earned in a given time frame, like could be 3 years, could be 4 years, could be 5 years, minus how much it cost to fund the project. So if it costs you $5 million, then you have to do negative 5 million plus, your company's future DCFs or your future DCFs minus 5 million. Pretty much the same math. And then we have payback period. This is the time it takes for a company to achieve an NPV of 0. So basically, it's how long it takes for your investors to get paid. So if I spend $1 million, like if I gave a company $1 million for a project and they pay me back within 4.5 years, the payback period is 4.5 years. So over here, it says that a particular investment was $150,000. That's going to be negative right here. Year one, well, actually, each year they bring in $32,000, and it takes about 4.69 years in order for the NPV to hit 0 for the investor to get all that money back, the $150,000. Once you hit like a middle value, you just do however much is left divided by your initial number for the previous cash flow over here. So that's payback period. How long does it take for me to get paid? Internal rate of return. So this is the return for a project given its initial investment in future cash flows. This is once again when NPV equals 0. So what rate of return does my project have that makes the NPV equal to 0? And usually this is the measure that investors look at. So it must always be seen in relation to the cost of capital, otherwise it's meaningless. And by cost of capital, we mean what does it cost for you as the person running this project to keep it running? Now this is mainly from debt and equity. We're going to be measuring IRR in relation to WACC. For now, just think of it as the cost of finance. It's the cost of debt and equity. We want the IRR to be higher than the cost of financing. Because think about it. You want the returns for a project to be greater than the percent of outflows. You want it to be greater than the interest you pay or the equity that is expected from the investors. That's why the IRR has to be higher. It has to bring in more than it lets out. It's good. If your IRR is less than your WACC, that means the project's no good and you got to head the other way if you're an investor. Or if you're funding the project, then you have to make sure that somehow that IRR gets higher. You have to cut your weighted average cost of capital. We'll see ways that you can do that when we deconstruct the equation. You have to find ways to increase the IRR by increasing future discounted cash flows for your firm. There are many ways to do it, but you never want your IRR to be less than your WACC, because then you are almost guaranteed to lose money if you're an investor. And even if you're running the project, that's not a very good project. And finally, profitability index. This one's, in my opinion, the easiest one. So this is how profitable a company is, or how profitable a project is, really. This is a bit of a misnomer. You're just going to do the present value of future cash flows or company DCFs divided by your initial investment. Payback period, NPV was your sum of future cash flows minus initial investment. This is DCFs divided by initial investment. This number, it could be above 1, it could be below 1. It doesn't matter. You have to see it in relation to the industry. You always have to compare. And, okay, so this is the last thing. So amortization schedule, this is basically a table or schedule that lists each regular and equal payment on a loan. These are very helpful for anyone doing corporate finance, FP&A, when they're paying off a loan, right? Because as a company, when you take on debt, lots of debtors are going to want you to pay equal payments of interest or equal payments of interest plus principal every period. That period could be 6 months, it could be 3 months, it could be a year, it could be 2 years. Usually it's about a year. So in this case, we calculate that the payment we make every year for 12 periods is $851.50. So you see how with that equal payment, we are able to pay off a loan of around $10,000 with equal payments year by year by year. There's a function in Excel for this. It's called PMT. And then it goes down perfectly to 0 by year 12 or by period 12. It's not necessarily year. So you can calculate this using the PMT function. I don't know if I do that. I can if you guys want. But this is very important when it comes to putting down on your balance sheet and putting down on your cash flow statement how you're amortizing loans. You know, how much are you paying off? How frequently are you paying them off? And you know, the intervals plus the amount you have to kind of take into account and put it onto your balance sheet so that it could be amortized. And that potentially could play into your EBITDA, that could play into your balance sheet and other financial statements as well. So amortization schedules, very important. And it's also cool to have, you know, if you're paying off a mortgage, it'll be cool if you use that PMT function and see, you know, for a given mortgage loan at a given rate, if I pay it off over the course of the next 30 years, how much will I have to pay per month or per period? You can do this yourself. You know, this doesn't have to be a corp finance thing. So I find amortization schedules very helpful. All right, we're at the Excel example. Awesome. So I'm gonna be opening Excel. Can everyone still see my screen? You just type it in the chat if you can. Can you see the Excel sheet? All right, we are good. Awesome. So this is the last thing that we're gonna do, and we're on time, so that's good. It's gonna be very simple. So essentially, we want to see which company project is better. I really should have titled this Project A, Project B, but it's the same exact thing. We want to see which company is better. Which project is better from each company. So we have a list of inflows and outflows. Year 0, this is investment. So that's how much the investors put into it in the first year, which we're technically counting as year 0 here. And with each passing year, you know, you have these cash flows. They're growing. Right off the bat, you can't really tell anything. Maybe you might think company A is better because its year 5 cash flow is way higher compared to company B. Maybe you might think company B is better because its upstart cost is way lower than company A. We don't know yet. We're going to find all 4 of these values that we talked about, and we're going to, you know, see if our assumptions were correct. And we're going to be using a discount rate of 8%. That's just your, you know, your cost of capital, your R, if you will. That's the R. We're going to be going more into WACC later, so I don't want you guys to like worry about that too much if you don't know about it yet. But that's what we're going to be using for present values. First thing we do, calculate the present values. All right. Here's what I would like to do. First off, for year 0, the present value is just the present value. Right. We don't need to PV it because that is today. That is money we spend today. It's not a year from now. It's not 2 years from now. It's the same exact value. Now we get into the next couple of years. So I want to PV 60,000 for company A. What's the equation? The equation is the future value, which is 60,000, divided by 1 plus R to the power of 1 in this case. Now, instead of typing 1, just so we can automate this, what I would like to do is I'm going to use the write function. And what the write function does is it takes a string and you can type in how many number of characters you want from that string and it'll take it there. So what I want to do is take the string of year 1 and just select the first character. And that first character is the number 1. So from the right, the first character in year 1 is 1. And it calculates. And I'm also going to F4 the WACC, right? So it stays there. Now, if I drag this over, all the PVs are automatically done. I don't have to do anything extra. It takes the D2, your 80,000, divides it by 1 plus 8% to the power of 2. In this case, it's the first character to the right, all the way to the right of D1, which is 2 in year 2. Same thing with 3 in year 3, 4 in year 4, 5 in year 5. All right, let's see if this works here. This is C3. Okay, so the only thing we have to change here is we're looking at C1. There we go. And now we just do the same thing. All the present values are done. If anyone has any question on what I did in terms of the Excel, you can let me know. You can text me. You can even put it in the chat. But this is the easiest way to do it, because I think this straight up took me like a minute without explaining and about 4 to 5 minutes with an explanation. So we have our present values. Now we do our net present value. Our net present value, the easiest thing to do would just be to take a sum here. Our initial investment, which is already negative, denoted by the parentheses, plus our future discounted cash flows. All right. We do the same thing here. I don't know why it's like that. Okay, there we go. Okay. IRR, there's an IRR formula because it's very hard to calculate yourself. Okay. That's it, IRR, and all you have to do, actually, sorry, I did the wrong cash flows because they have to be the discounted. Okay, profitability index. This is going to be the sum of your DCFs divided by your initial outflow. So let's do this. Sum for company A is this, divided by the outflow, the negative outflow, because we don't want it to be negative. And that's what it is. I'm going to decrease the number of decimals. Okay, same thing. Here for company B, we just take the sum of the inflows, we multiply, we divide it, by the negative outflow, and we get this number. We get the same thing here. Yeah. Okay. Cool. Now we do payback period, which is kind of a manual thing. So for payback period for company A, I'm going to be just taking the sum individually until I get to 400,000. Okay, so 313. So it's not going to take the full 5 years, but it's going to take 4 point something. So in order to get that point something, we do 400,000, or really negative 400,000, so it's positive. Negative 400,000 minus this. And then we take that 86. Oh, this is how much we have left to pay in year 5. Or the company has left to pay, divided by how much total you are expected to earn in year 5. That's about 55%. So for payback period, I'm going to do 4 because it takes 4 full years plus this. And it's about that, 4.55. And now we do the same thing for company B. We're going to wait until we get to 250K. Okay, so we know that it's not going to take the full 5 years here either. We're at 211. We do the same thing. We negative 250K minus this number, we get that. We do the 38,965 divided by how much we're projected to earn in year 5, and we get 0.33. So we're just going to do this, 4 plus 0.33, and we get about 4.33. Now we can finally compare these two firms based on equal measures. Let me do this one again. Okay, there we go. Yeah, I don't know why it's 469. Okay, got the IRRs, got the profitability indexes, and the payback periods. Okay, which company has the higher NPV? Let's go one by one. Company B. So already, company B1, company A0. Which one has the higher internal rate of return? Company B. Now notice the IRR here isn't great. It's exactly at 8%, which is the discount rate here. I don't know if it's exact. It's actually a little lower. That's not great. We want it to be higher, but it's better than 5%. So we're sticking with 8%. Which has the higher profitability index? B. So in 5 years, it has higher profitability. It has more discounted cash flows that it's bringing in compared to how much we are investing as investors. And finally, which has the lower payback period? Now remember, payback period, we want to be lower because the less time it takes for the investors to get their money back, the better. We don't want more time spent on investors getting their money back. We want that 4.34 compared to the 4.55 because it takes less time for the investors to get their money back, their return on this project. So this one's also going to go in green. So this is a bit lopsided. From this, we know that company B is better. We know that company B is going to be the one, ideally, that we're going to want to do business with. We're going to want to fund. Okay, I don't know why that didn't work. Company B is better. That's the moral. And how do we find that out? We found that out by using all of these measures, NPV, IRR, profitability index, and payback period in order to come to this conclusion. So that's it from me. That is my entire Excel demo. I'm going to stop sharing right now. Kind of threw that together really quickly. I'm going to stop recording now. So if anyone has any questions, I can answer those right now once I stop the recording.